Welcome to TheoTrade. This is Don Kaufman. It's February 27th, 2019, and you are watching the TheoTrade evening video. Well, with about 20 minutes left inside of today's trading session, the S&P futures once again are massively unchanged. Volatility or lack thereof. With that, let's get to some specifics and really drill down to what's going on inside of this market. Also give you a little bit of a trade idea, trade opportunity that happens to be emerging. Let's go ahead and start with the SPX specifically, and I'm going to go ahead and zoom in on this week's expected move. For those of you that are unaware, the hash marks, the lines on your screen that is, happen to represent the expected move of this given week. Now, again, the SPX is exactly where the week started out. Where is that? Exactly where we're at right now. So not only are the S&P futures and the S&P is largely unchanged specifically in today's trading session, but right now we're sitting massively unchanged for the entire week. Well, at least we're through 3 days of the week. Nevertheless, as we talk about kind of incessantly here, in almost each and every week that we pass through, the probability of hitting, one of the edges of the expected move is extraordinarily high. So with that, and again, the fact that we only have Thursday and Friday left in this trading week, I'm going to counter the lack of volatility with, you better expect some movement inside of the marketplace, and very likely could take off. Again, the upside here is right around 28, 27. To the downside, we're just about 27, again, 60. So we've got, again, a decent range that we could be moving in with Thursday and Friday. And again, I'll reiterate this time and again that there's a fairly high probability of hitting one of the edges of the expected move, in any given week. The fact that right now we're sitting largely unchanged does leave us in kind of a precarious position for Thursday and Friday's trade to see some fairly tumultuous movement inside of the broader marketplace. Now, what's kind of on our mind today and what's really driving trade? The biggest mover on the screen, again, it's not the S&Ps, and that's where everybody kind of has their focus. I mean, if the market closes today and there's a big donut up on the screen, the S&Ps are zero, massively unchanged, you'd be missing the bigger picture. What's the bigger picture? It's all about the bond market. The bond market is absolutely getting rocked. Now, for those of you that don't necessarily follow the bonds, I'm going to take a look at the ZB. This is the 30-year U.S. bond treasury futures product. The bonds, for the most part, they have been largely unchanged, throughout the course of this year. We've been stuck right around this kind of 144, 146 range, which is, again, it's an incredibly tight range for the bonds. If I zoom out, of course, over the last, and this is approximately a 9-month window, you haven't seen this kind of a tight channel, anywhere on the screen. Again, the bonds rocketed in coming out of November into, of course, early December. This is when the sell side activity occurred in the marketplace. The bonds continued to rocket to the upside all the way into early January and then basically fell into kind of a lull. Right now, they appear at this point in time to be breaking down, and they're doing it even though there's a roll going on in the bonds. They're still doing this kind of breakdown in some decent volume. Now, what has a lot of us kind of perplexed about the bonds, as the bonds sell off, or the notes sell off, if we take a look at what's termed TNX, that's the 10-year treasury, this is the interest rate or the yield associated with, if you will, with the 10-year. This is now popping to the upside, The moment that we see bonds sell off, interest rates, of course, pick up. Now, the beneficiary of that is very often the financials. Do you see that in today's trade? Because I don't. The financials are up, 0.3%? It's a big nothing. In fact, I've talked again kind of incessantly about this 2650 level inside of the financials. So the financials are not necessarily the beneficiary, at least in today's trade, of the bond market getting rocked to the downside. Now, there's more on this front that I kind of want to bring into perspective. This is something that maybe not everybody looks at on a day-to-day basis. Well, I bring it up quite often, but here we go. What you happen to be looking at, and again, it's a whole lot of numbers. What you happen to be looking at, this is the Department of the Treasury, okay? This is also another way of looking at what we term the yield curve, all right? Big movement in the yield curve. And what we often look at to determine if the yield curve has inverted would be like a 3-year, for example, against the 5-year. Now, I'm going to take you into a little bit of perspective over here because this is a 3-year, okay, or apologize, a 3-month against a 5-year. What does this mean? Again, whole lot of numbers. All right, here's the rate associated with it, 2.45. If you look out at the 5-year, this is 2.45. Well, this happened to be yesterday's trading data, right? So at the end of each day, the Treasury updates the site. At the end of today, what you're going to see is that the 3-month has now eclipsed the 5-year, which effectively means the yield curve itself has actually inverted. Again, one of the key metrics of this is a 3-month, okay, versus a 5-year and the inversion of that. That basically means, again, that the 3-month, the rate associated with that is above the 5-year. I mean, there's a chance that we even see 3-month start to eclipse even what? The 7-year or the 10-year. Why do I bring this to your attention? It's because that is, if you will, the telltale sign of recession. Now, that doesn't necessarily indicate that we are here. It's a recession right now, okay? But it has been the indicator that, again, a lot of economists, a lot of traders have looked at, all right, for literally pretty much since this has been tracked, okay, as an indicator of recession. Now, granted, I could probably make a counter argument. There's been so much influence from the FOMC that we're not exactly sure what to expect in terms of the yield curve. Nevertheless, what has me as a trader a little bit perplexed is why the marketplace isn't seeing extraordinary volatility off of this. Okay, because right now, again, would you know that the yield curve inverted looking at this? Absolutely not. You'd look at this and be like, well, nothing happened today. Again, the inversion of the yield curve is a very, very big deal. Okay, is it being priced that way? Absolutely not. Okay, however, I might not be the only one that's seeing the movement in this. And I say that because let's go take a look over at the VIX. Now, the VIX is largely unchanged. Again, largely unchanged in today's trading session. If I open up option statistics, there's maybe 300,000 contracts that have traded, which, okay, according to this sizzle index, is about half of the normal. Okay, but what we are going to find out is that there are some traders that have been out there gobbling up volatility in a very, very big way. What I'm showing you right now happens to be, again, just 2 trading sessions ago. And if we open up the April options, okay, people I think are probably unaware that this kind of activity is going on. What you're looking at is some of the largest volume that's been recorded in the VIX, right? Anytime in the last year. Now think about some of the tumultuous volatility we've had over the last year of trade. Okay, take a look. This actually comes again from Monday's trading session. Somebody traded 145,000 of those, 100,000 of these, 100,000 of these, 155,000 of those. Okay, it doesn't stop. All right. Then they were on the puts heavily, doing over 100,000 contracts in the puts. Okay, actually it's about 150,000 contracts in the puts. Absolutely massive size. Now, this is not to sit here and to paint you a bearish perspective. Not at all. Okay. There are buyers of volatility, and you need to know that. Okay. Now, the fact of the matter is, just because we know that somebody is trading out in the April options in the VIX does not constitute, again, that they're taking a gigantic bearish position. This could be, for example, a big fund manager. They have 5-10 billion under management, and they could be out here using VIX options to mitigate their own risks. That is, they're using it as a hedge. So they're either using it as a hedge, or number 2, they are in fact taking a wicked downside shot. The thing is, in this marketplace, you can't see somebody else's hand. Okay, either way that you want to proposition that trade, either number 1, they're using it as a hedge, or number 2, they're actually out there taking a downside shot. Okay, either way you want to proposition it, This is somebody that is very fearful, okay, of a down move inside of the marketplace. And again, now you can see in today's trade, there's a much lighter trade today. Nevertheless, the open interest in the VIX in April is huge. Now, if you take a look at the VIX itself hasn't really popped up. What has had movement is the VVIX. That's the volatility of the volatility index. And of course, you can see on Monday, the VVIX, again, taking back off to the upside. So there is movement out there. And again, we now have the yield curve that's flipped over. It's inverted, right? We have somebody on the bid inside of the VVIX. This stuff absolutely matters. Now, the marketplace, what's its reaction? Nothing. In fact, the marketplace today hasn't reacted literally to anything. There was actually news out of China, okay? Maybe the trade, deal is not going to be so easy to get done. That basically caused what? A heart-pumping 3 minutes of trade. I mean, the S&Ps basically fell 8 points on the idea of this trade deal kind of unwinding. Moreover, okay, pending home sales came out. There was a jump of 4.6% month over month, but the pending home sales dropped, okay, 2.3% year over year. That is from a year ago, all right, January, they were still down, okay, here in 2019, 2.3%. Did it influence the market? Absolutely not. In fact, nothing seems to influence the market. Specifically, the market we're looking at right now happens to be none other than the XHB. It's the home builders. Okay, the home builders is something I've talked about in the last, few evening videos a couple of times here on the TheoTrade chat room. Here's where I am substantiating a position. If you look at the year-to-date percentage, the home builders are up. It was just shy of 20%. Okay, now the home builders, again, if you take back a little longer look, so on a 3-year period, have rallied back up substantially. I am once again substantiating what we term a duration position inside of the XHB. To substantiate that duration position, I am using deep in the money puts as synthetic short stock. That is, you can go out, you could just short the XHB. But if you're in an IRA or you want to preserve your capital, why go out there and short, a $38 product? Instead, okay, or in lieu, we're going to go ahead and we're going to purchase, okay, the 42 puts. And again, we see a marketplace of 320 at 330. It's not half bad. I'll go in here in the middle about 325. I continue to fill contracts throughout the course of the session. Of course, you can see I'm 325 bid. This duration put filled. This duration put is something that I will continue to roll over for many, many months to come. Anytime I denote duration, that is going to be in excess. Again, that's a time frame in excess of 3 months. With that, I want to thank everybody for joining us here at TheoTrade. Have a wonderful evening. Hey, Don Kaufman here. From May 30th to June 1st, the TheoTrade team will be hosting the Volatility Strikes Back live event in Scottsdale, Arizona. Here are the top 10 reasons you need to attend the Volatility Strikes Back live event. Number 10, perfect your trading. I don't know about you, but I've never been a fan of guessing. I want to know exactly what I'm doing wrong and how to fix it. Find out the right adjustments to your trading. You can have one or more TheoTrade instructors look over your shoulder to get your trading right. You can't get that anywhere else. Number 9, trading can be hard, a bit lonely, and sometimes just downright scary. Get out from behind your computer and join like-minded people. You'll realize you are not alone. The TheoTrade community is amazing. You can't always talk to your friends or your family about what you're going through. And at Volatility Strikes Back event, you'll find traders just like you. Some of them further down the road than you and others behind. Together as a community, we can make it happen. Number 8, volatility is so very back. Now is not the time to slow down your trading education. Now is the time to accelerate your learning because there is a ton of opportunity in the markets. Find out what's missing in your trading and create a unique trading plan just for you. Number 7, want to get away? Does your life remind you of one of those Want to Get Away Southwest commercials? Well, if you need to get away from a nagging spouse or screaming kids, then the Volatility Strikes Back is your ticket out. I know it's mine. Number 6, you are who you hang out with. I like this quote. You're the average of the 5 people you spend the most time with. For the last 20 years, I've spent most of my time around 20, 30, or even 40-year veteran professional traders. Being around like-minded people helps you focus, encourage, and sharpens the saw. Number 5, trading is a competitive business. You're competing against some smart traders out there, and those that come to this event are going to have an edge that you won't. Full immersion into a subject is the best way to learn and absorb the information. At home, there's a lot of distractions that can take you away from focusing on your trading education. Enjoy a 2-day immersion into your trading without any distractions that will take your trading to the next level. Number 4, have a lot of fun. Join us and you're sure to have a great time, accidentally or on purpose. If you're the most parts of the country, you're used to wild weather. Scottsdale, Arizona is absolutely beautiful in late May. The weather is perfect, not too hot just yet. So bring the spouse or kids and have a great time. Number 3, resort discount. We have an incredible discounted rate for you at a 4-star resort in Scottsdale with the typical resort fee waive, plus breakfast and lunch are included. Our room block is filling up fast, so join us while you still can get that fantastic discount. Plus, if you wait any longer, flight costs will increase. Number 2, work on your trading. You need to take time away from trading to work on your trading. If you're like most traders, you're so consumed with trading that you forget to work on the strategic level of your trading. When you work on the higher level strategy of your trading, that's when you're going to see big results. Number 1, be with professional traders. All of the Volatility Strikes Back instructors are professional traders. Don, Tony, Corey, Jeff, Matt, Slim, Brandon, we are all going to be there and ready to answer your questions. You know, you can go to a seminar anywhere and spend $3,000 to $5,000 for a live event to get generic trading information. Or you can come to the Volatility Strikes Back event and get specific information at a fraction of the price. Whether you trade options, swing trade, or intraday trade, you'll get the specific information and the case studies that is directly related to your trading. You do not have to trade alone. TheoTrade is here to help. Don't miss out on this event, May 30th to June 1st in Scottsdale, Arizona. Go to TheoTrade.com/live. Again, that's TheoTrade.com/live. Or click the Add to Cart link, and I'll see you in Scottsdale in May.